Hello, everyone. Welcome to another Adam Live video. And on today's video, I'm going to be talking about zero tax Roth conversions. Is that even possible? How do you most effectively engage in Roth conversions? We all know it's a super valuable tax tool. One of the only ways that you can turn taxable income into tax-free income, and there are strategies for doing it better. So I'm going to put on my tax attorney cap. I'm going to mess up my hair and put up my tax attorney cap and talk to you about some of the strategies that can be employed to reduce taxable income on a conversion and at the same time helping you get taxable assets into a tax-free sheltered Roth IRA. So I'm going to first start off by chatting about the difference between a pre-tax IRA and a Roth IRA. Then talk about Roth conversions, how they work, taxable ramifications, and then go into some of the strategies to zero out any potential tax on a conversion. So what's the difference between a traditional IRA and a Roth IRA? So before 1997, there was only one type of IRA. It was a pre-tax IRA, meaning you got a tax deduction for what you put in the IRA. And so long as you're over 59 and a half, when you pull the money out, it would just be subject to income tax. Not capital gains, but ordinary income tax. Now, the two advantages of a traditional IRA is, number one, you get a tax deduction for what you put in, $1,000 if you're over 50. There are some limitations if you have access to a 401k at work, or if your spouse has access to a 401k at work. There are limitations on an income standpoint on whether you can make contributions to a pre-tax IRA. But putting that aside for now, assuming you can, the first advantage is you get the deduction. And the second advantage is your money grows without tax. And that's known as tax deferral, right? As you put in contributions each year, your money is going to grow. So if you buy Apple stock and then sell it and there's a gain, you don't pay tax on that gain, right? It's deferred. It's in an IRA. So those are the two primary advantages of saving through an IRA. And that's what Congress is incentivized us to save. We live in the United States, which has a private retirement system. It's not a public system like some European countries where the government will save for you. Here, it's our obligation to save. So government will give us Social Security. We hope it will be available when we're older, but there's no guarantees. So it's up to us to save. And the IRA is the most popular way to save. There's over 60 million IRAs, approximately $13 trillion in IRAs. And it's a great vehicle because they're easy to set up and you have a lot of investment options when you use an IRA to invest. You get the tax deduction when the money goes in, and so long as you keep the money in the IRA, it grows without tax, which is known as deferral. Roth conversions were established by Senator Roth in 1997, and it's really a flip side of the pre-tax IRA. So you do not get a tax deduction when you make contributions to a Roth IRA. Same contribution limits, $6,000, $7,000 if you're over 50. But so long as you're over 59 and a half and the Roth's been open at least 5 years, you can pull the money out and take a Roth IRA distribution tax-free. Okay, so that's the game. That's this play. That's what we're all here talking about. How do you get your money into a Roth IRA? In an IRA, you only can do $6,000 or $7,000. In a 401k, you can do employee deferrals of $20,500, $27,000 if you're over 50. And if you're in a solo K, you have the opportunity to do a mega backdoor Roth, which will get you $61,000 or $67,500 if you're over 50. But going back to the IRA world, the most popular way of really getting money into a Roth IRA is conversions. Why? Because you can only make $6,000 or $7,000 of contributions each year. And unless you're Peter Thiel or a super intelligent person, it's awfully hard to turn a few $1,000s into hundreds of thousands of dollars because the contribution limits are so low. Now, if you start early, you can do it. But someone in their 30s or 40s that just wants to put in $5,000, $6,000 a year for a few years, it's going to be awfully hard to get that number up to a number that's going to work for at least a nest egg for retirement. So the most popular way of really enriching a Roth and expanding your Roth holdings is to convert what you have in a pre-tax IRA or 401k into Roth. Okay, and we'll get into some of the strategies in a minute. So as I mentioned, Roth IRA distribution rules are as follows. If you're over 59 and a half, Roth has to be open 5 years. It's all tax-free. Under 59 and a half, you can always pull out the contributions tax-free. So if you put $5,000 in a Roth IRA at age 30, you can pull them out the next day, tax-free, because it's after tax. But the earnings on those contributions, you have to wait till you're 59 and a half and the Roth's been open at least 5 years to pull out everything tax-free. Okay, so that's why it's super important to have patience, trust the process if you're in a Roth. If you don't trust yourself to be patient, you may not want to do a Roth because you're going to lose the power of the Roth. You're going to lose the potential tax shelter opportunities that are built into the Roth if you aren't patient and you have to pull the money out. Whereas if you pull the money out of a pre-tax IRA, you lose the deferral, but you don't lose the ability to shelter all that income from tax. So you're really just dealing with a 10% penalty. So it's not as egregious to take a pre-tax IRA distribution as a Roth. Now, who can make Roth IRA contributions? Well, like a pre-tax IRA, there are income limitations. For example, if you're married, filed jointly, and make more than $214,000, you can't do a Roth IRA contribution. But there's a workaround. Back in 2009, when we had a financial crisis, the government needed money. And what they did is they suspended Roth conversion rules. So before 2010, essentially, if you made more than $100,000, you couldn't do a Roth conversion. Okay, but they suspended that rule because they wanted people to do conversions. Why? Because when you do a conversion, you prematurely pay tax, which the government likes because you're giving them tax revenue before you generally would have to, which any government cares about what happens today or in the next 4 to 8 years, not what happens in the next 30 years. So conversions are actually a very attractive tool used by the IRS and Congress to accelerate revenues for them. So they essentially eliminated that rule and they haven't reimposed it. So right now, anyone can do Roth conversions. Okay, so there's something called a backdoor Roth IRA, which means if you make, even if you make more than the $214,000 married filed jointly, all you need to do is an after-tax IRA contribution and then convert it to Roth. And since there's no income limitations on conversions and it's after-tax to Roth, there's generally no tax. Now, if you have some pre-tax IRAs out there, as I've mentioned in other videos and podcasts, there's a pro rata conversion rule that will limit how much of the after-tax can go to Roth. But assuming you don't have any other pre-tax IRAs, you can literally, if you're Jeff Bezos and make $1 billion a year, you can still do a Roth IRA. You just need to open a regular IRA, put up to 6,000 or 7,000 if you're over 50, and then immediately convert it to Roth. Just don't take a deduction for that IRA contribution. And because of the backdoor rules, anyone could do the Roth. So now that we know the difference between a pre-tax IRA and a Roth, how do you get your money into Roth? So as I mentioned, since 2010, anyone can do a conversion. We talked about backdoor Roth IRA conversions, which is after tax to Roth. A Roth IRA conversion is pre-tax to Roth. So that is a taxable event. That's the difference between a backdoor Roth IRA, where it's an after-tax IRA to Roth. After tax means you already paid tax on the money. So the government's not going to impose another tax on that income. A Roth conversion means you have money in a pre-tax IRA and now you want to get it into an after-tax Roth IRA. That is subject to ordinary income tax, not capital gains tax, but ordinary income tax, which obviously is based off your tax bracket, right? So if you made $100,000 of income as a lawyer and you want to do a $50,000 IRA to Roth conversion, your income is now $150,000. And the tax bracket you're in is going to be based off the aggregate amount of all your income, including the amount you converted. Okay, so it's important to keep that in mind. It's not a capital gains tax, it's an ordinary income tax, which, obviously isn't very attractive. But there are ways to maybe not zero out, maybe I fibbed a little bit, awfully hard to zero out, but we'll talk about ways to reduce the amount of the conversion. So the first thing is take advantage of bad times. Okay, 2022 has been a very, very tough year for investors. Okay, and I'll just read out some numbers. As of today, September 28th, 2022, S&P 500 is down 23%, Dow's down 19.5%, gold's down 9%, Bitcoin's down about 58%, Ethereum down 66%, Tesla down 29%, Apple down 14%, Meta down 62%. Pretty much everything's done. Everything's down. Okay, there's not really much that's up. If you are an investor and somehow your portfolio is up, well, call me. I need to know who your financial advisor is, because even the smartest advisors I know, and I have access to some of these folks, they're down 10, 11%, and they're kind of happy with that because it beats the market. So taking advantage of bad times. What that means is if you're bullish on Bitcoin or Ethereum or Tesla or Meta or S&P 500, convert now, right? If you believe that stocks will go back up in the future, maybe in the next month or the next 6 months or the next 2 years, or you're big bullish on Bitcoin or Ethereum or Tesla or any other asset that's decreased in value, this is a time to convert, because you're converting a depressed asset value. Because when you convert, you pay tax on the fair market value of the asset you convert. You do not pay tax on what you paid for it. This is a very important distinction. Okay, I want to be clear. You pay tax on the fair market value of the asset. Cash is cash, right? But assets like stocks, like real estate, like gold, like digital assets, like notes, change in value. Okay, so if you are bullish on the assets you hold and they've decreased significantly over the last year, or at least a time you're willing to do a conversion, or at least thinking about doing a conversion, makes sense to do it, right? Because, hey, if I think Tesla is going to go back up 30, 40% in the next 2-3 years, I might as well convert when it's down 28%. Same with any other asset, whether it's digital or stocks or real estate or hedge fund, private equity, doesn't matter. Okay, you do need to get it valued. Okay, and we'll talk about the steps to how to do a conversion in a minute. But the first tip is take advantage of bad times and depressed asset values. Okay, I'll go back to 2009, 2010. I can't tell you how many clients that are still with me, still clients of IRA Financial, that converted to Roth in 2009, 2010, 2011, when asset values, especially real estate, were down 40, 50%. And they're literally just living off the assets. They're in a Roth. Folks are now over 59 and a half. It's 12 years ago. And they're just living on the cash flow, on the rental properties, or they've sold the assets, and it's all tax-free. So it's like buying real estate, right? You don't make money when you sell it. You make money when you buy it. I had a really good family friend who was a brilliant real estate investor, super, super successful. He said, Adam, any idiot can sell real estate. There's always a buyer. Smart ones make money when they buy. Okay, that's the difference between a smart real estate investor and a successful one and an average one. Smart ones know when to buy. So same with conversions. The good conversions are all about the value you convert at. Okay, so probably conversions in 2020, 2021 won't be as successful as conversions in 2022, because if you converted Tesla when it was 30% higher, that means you paid 30%, you proportionally paid more tax on that asset than you would today. Okay, so that's the first tip. Take advantage of crappy times. Number two, I would say NOLs, okay, net operating losses. 2022 could be a year where your business may have net operating losses. Or it could be an active real estate business, it could be a restaurant, it could be a store, consulting company, whatever. Under the Tax Jobs Act of 2017, you can carry forward indefinitely NOLs from active businesses, not passive real estate. There are passive activity limitation rules on how much losses from passive activity you can use to offset active income. That's based on Section 465 at risk rules, Section 469. I don't want to get into all that now. That's something you should talk to your accountant about. But if you have active NOLs from an active business, you can carry them forward and literally use 80% for 1 year. Okay, so that means you can reduce your taxable income by up to 80%. Prior rules before 2017 was 100%, but the 2017 rules let you carry it forward unlimited. There were some rules in COVID that you carry back, but those have obviously finished. So now you can carry forward and use each year up to 80% of the losses to offset income. which is super valuable. So that means if you had $100,000 and you had $100,000 of losses, $80,000 of those losses could be used to offset the $100,000 of income, leaving you a taxable income of $20,000, right? So then if you wanted to do a conversion on top of that, your tax rate would be lower. So NOLs become very valuable, and 22 is going to be a tough year. So there could be business losses. And if you are in a position where you think it's a temporary business loss, the business is going to pick back up next year, then use those NOLs. You may want to use them and do a conversion to make use of those NOLs. Discounted valuations. That's the next strategy. Obviously, you can't take a discounted valuation in cash. If you had $1 million in cash in your bank account, it's hard to argue that that $1 million is only worth $700,000 because it's cash. But if you own illiquid assets like land or private business stock, or even private equity or hedge fund stock that's locked up, you may have the opportunity to get a discounted valuation. And what is a discounted valuation? It means, let's say you paid $100K for this piece of land that you own in an LLC, and now it's, let's say, worth 110. You may be able to get a valuation expert that would say, well, no one's really going to pay you fair market value to buy into an LLC that you closely hold and control. So maybe that land, if you're selling a minority interest in that LLC, so you're going to sell 49% of it, convert 49%, a valuation expert may say, you know what, that land's not worth 120. That LLC interest that owns the land, maybe it's only worth 70 or 80, because who's going to pay full value for a minority interest in a closely held LLC that you control? So those are the type of things that are available. And there's valuation experts across the country, depending on the facts and circumstances of your situation, that may be able to give you a discounted valuation. Now, the IRS may not buy it, right? There are occurrences where the IRS may say, you know what, Adam, we don't buy your valuation, get a new one. Or we just don't think there's a discount here. And that happens. You see these a lot in family estate partnership cases. And these cases, have been common for the last 30, 40 years. So there's common case law and precedents for discounted valuations. It's not something that's super alternative and super aggressive. This is pretty standard stuff that a lot of good valuation experts can help you with. So there are opportunities, depending on what you're investing in, to get a discounted valuation on your asset and then convert based off that discounted valuation. Now, Tesla stock or cash, more difficult than if you own a private business or land, stuff that's hard to sell, illiquid, lack of marketability, that will help you get a discount, especially if you own 100% of the LLC and you're going to do a conversion of less than controlling interest, maybe less than 50% or less than 66 2/3% if a supermajority is required. That percentage will generally be available for a discounted valuation because, again, on the open market, selling a 49% interest in a company is not going to fetch the same price of selling 100%. Okay, especially if the asset's liquid or locked up for 5 years, discounted valuations could make sense. Low income years, right? As I mentioned, for NOLs, 22 could be a tough year. 23 maybe even a tougher year. We hope not, but there's no guarantee we're going to have a soft landing on inflation and whatever comes next. So if you have a low income year, think conversion, right? Maybe add a little bit of money. Let's say you used to make 100 each year, now you're making 50 or 60, whether you took some time off from your job or you got laid off, whatever the case may be, could be a good opportunity to take advantage of doing some conversions to getting your income, using the fact that your income's low and having a lower tax bracket on the conversion. Timing's key. You don't have to do a full conversion. Okay, let me make that clear, and I'll second that. I'm just going to pause. You do not have to do a full conversion. A lot of people think you have to convert your entire IRA or the entire piece of land or all the stock you own of Tesla or all the LLC partnership interest you own or all the hedge fund interest your IRA owns. No, you can do partials. Okay, you can do an acre out of the 2 acres. You can do 30% of your LLC. You can do 20% of your interest in the hedge fund. Okay, you can do whatever you want. So a lot of clients what they do is they break it down. They say, hey, I'm 45. I want the 5 years and the 59.5. So I want to get to 55. So I have 10 years to do these conversions. Hopefully the asset doesn't increase too much in value. And that's the risk of doing timing. But let's say you're going to do it over 3 to 5 years. Say, okay, I have 200K to convert. If I do it over 5 years, it's 40K a year. My tax bracket may not go up, right? You can always run the numbers with your accountant and say, okay, I'm in the 20% tax bracket. I have another 30 grand of income before I go into a higher tax bracket. Let me convert so I'm just at the top of my current tax bracket without going higher. Okay, so there's all this stuff you can do. And that's why I always say it's really important to get a good accountant, a good tax advisor to work with to kind of work you through these numbers, right? You may come up with the strategies, but you want a good accountant that can help you with the numbers. So let's say you're in the 20% tax bracket and the next tax bracket, as I mentioned, is 30 or 40 grand away. Your accountant may say, okay, Adam, why don't you do another 30,000 a conversion this year? You're only going to pay 20% tax on it. It's not horrible. And keep doing that for the next 2-3 years. And eventually all your pre-tax IRA funds will go Roth. So timing can help. It's obviously painful. Let's say you had a $500,000 Roth IRA. It's obviously painful to do it all at once. Now, there's no 10% conversion penalty, okay? I should have said that up front. When you do a Roth conversion, all you pay is ordinary income tax. There is no 10% penalty, okay? No 10% penalty on conversions. Only a 10% penalty on distributions. So all you do is pay ordinary income tax based off your other income and your tax bracket. No 10% early distribution penalty. Okay, so I wanted that to be clear. I made a note to not forget that, and I did. So I'm not forgetting, and I'm going to stick it in kind of at the end, but it's important. Just ordinary income tax, okay? If you have other deductions, right? Making contributions to a 401k at work, for example. Let's say you can put $20,500 in a 401k. That's a deduction that will lower your taxable income. If you lower your taxable income, you'll have more room to make conversions and not go up tax brackets, right? So all the deductions you can take advantage of, if you itemize or not, you want to look into that, whether it's charitable deductions or whether it's pre-tax IRA or 401k contributions. All those contributions will help reduce your taxable income, which will then allow you to do more conversions at the same tax bracket. So it's hard to zero out. The NOLs will get you 80%, reducing your taxable income all the way to 80% of what it is. It won't let you go to 100%. Obviously, if you have losses in the current year, then conversions are helpful, right? Let's say you had, a tough year this year and you're really not going to have much income. Then obviously a conversion would make a lot of sense because your tax bracket is going to be super low. Now, what about using your Roth IRA to pay the conversion? So this is an important point, and I talk to clients about this a lot. If you're under 59.5 and you do a Roth conversion, you still have to wait 5 years to pull the money out. The difference between contributions and conversion rules are as follows. When you do a contribution to a Roth IRA, you could pull the money out anytime you want. The contributions, not the earnings, but the contributions. Where if you do a conversion, if you're under 59.5, you have to wait 5 years and be over 59.5 to pull the conversion out, the amount you converted. So for example, if you converted 50K and you're 52 years old, you'd have to wait till you're 59.5 to pull the 50K you converted out tax-free. If you contributed $6,000 today, you can take the $6,000 out tomorrow without penalty or tax. If you're over 59.5 and you do a conversion, you don't have to wait the 5 years for the converted amount. On the earnings, you still have to wait the 5 years, okay? So if you're under 59.5, don't think about using the amount you convert to pay for the tax because you're just gonna have to pay penalty on what you converted. It makes no sense. If you're over 59.5, then yeah, you can pull the money out to help pay the tax. So that's an important distinction that a lot of people don't realize. I'm not a big fan of using the Roth IRAs funds to pay the tax. I just think you're taking from one pocket and just putting in the other. It makes no sense. Do conversions if you can actually pay the tax. Conversions are due on April 15th of the following year. So if you convert in September, you pay tax on April 15th. If you convert January 1, 2022, you pay tax April 15th, 2023. And again, you pay it, it's on your 1040, so it's an ordinary income tax that generally is paid with taxable funds. You can take a distribution to pay the tax, but you got to run the numbers to make sure that makes a lot of sense. Often it really doesn't. Whereas if you're over 59, it may make a little bit more sense. Should you do a Roth conversion? And I'll spend a couple of minutes on this. I've done a bunch of videos on this topic. I've said this before, I'll say it again. There's no right or wrong. You can pay me $1 million. You can pay the next lawyer $1 million, whether they went to Harvard or Yale. It's based off facts and circumstances of the taxpayer, right? What can you pay the tax? Number one. What's going to be your tax rate when you retire? If it's super high, maybe a conversion now makes sense. If it's super low, maybe staying in ordinary pre-tax IRA makes sense because taking a distribution won't be costly. Your bet on what you're converting on, right? Are you converting Enron or are you converting, Google stock? What are you converting? That's also important, right? That's going to determine if it makes sense or not. Your age, doing a conversion at 80 may not be as smart as doing it at 25, right? You have more time to enjoy the Roth benefits. A lot of people think about doing conversions to help their kids, right? Let's say you're 75 years old, or how about this? You're 65. Pre-tax IRAs have required minimum distributions. Okay, so I actually talked to a client about this a few weeks ago. He's prior to the age of 72. I forget his exact age, but it's someone in his 60s. It's like, Adam, I don't really need this money. This money will be for my kids, maybe my spouse. Maybe I'll use some of it, but I have enough. I don't need to live off this. But what I want to do is I want to convert this to Roth now. So number one, my spouse and my kids don't have to take RMDs because Roth IRAs don't have RMDs, and they'll be able to take the money out tax-free. IRAs and Roth IRAs are all in your estate. Right now, the unified credit is still $11.5 million. So that the IRAs will count towards traditional Roth. It's part of that number. So it's not going to get out of your estate tax, but you can get into a Roth. So maybe your spouse or your kids don't have to pay tax on what you leave them. So it's kind of a nice little legacy tool that some clients use as a way of giving tax-free income to their kids and using some of the money. In this case, the gentleman was talking using Roth IRA money to pay the tax because it's like, I don't really need it. And I'm over 50 and a half, so I can use the money, pull it out, pay the tax, and then let it grow 10, 15, 20 more years. Hopefully I'll live that long. And then my kids will have 10 years to pull the money out tax-free. And it's a nice little tax-free gift. So there's all kinds of nice little strategies you can employ, but it's based off your facts and circumstances, right? Someone in this gentleman's position at 65 that didn't really need the money, his strategy is different than someone who's 45 and needs the money, or someone who's 68 and needs the money to live off, right? And in that case, maybe that individual will not do a Roth conversion because his tax rate may be low, he's retired, he's playing golf all day, he just has passive income, and he's going to need that IRA money to live off, and his tax bracket will probably be quite low because he's retired. So this is all the stuff that goes into the pot when you're mixing the soup and figuring out how it's going to taste. All these ingredients matter. And whether you're working with IRA Financial or your own tax advisors, we suggest asking questions, talk to people. You have time to make these decisions, right? Roth conversions have time. When assets drop, they generally don't stay down for a day. So if you want to convert Meta or Bitcoin or Ethereum, you have time, right? Maybe not years, but weeks and months. So think it through, ask questions, think about what your income level will be when you retire, or where it will be in the next 5 to 10 years. How you're going to pay the tax? Do you have losses? Do you have a lower income year? Do you have NOLs? Your belief in your asset. Are you a strong advocate for what you're investing in, or you're like, hey, just buy an S&P 500. I don't really care. It's going to hopefully go up over the next 20 years, and it is what it is. Or you're a passionate investor and believe in this private business you're investing in, or a Bitcoin advocate, or Ethereum lover, or a gold proponent, and you believe gold will go up 50% in the next 2 years because of inflation. All that matters. And that's why I go back to my point. There's no right or wrong answer. It's really just kind of mapping out a strategy for you and kind of following your profile and following a set plan. So hope you guys enjoyed today's video. There are ways to really reduce the amount of the conversion. Roths are super powerful. People don't understand it. I'm trying to help educate people. I've written a book on the Roth IRA. In God we trust, and Roth we prosper. All my retirement accounts are in Roth. I've done it over time. I didn't do conversions all at once. So I've used my youth over the last 10 years to convert all my assets to Roth. And I'm hoping the IRS doesn't change the rules in the next 30 years, but God willing, I live that long, and all my retirement assets will be tax-free. And I don't know where tax rates will go. No one does, but I'm not really going to care because it's all going to be tax-free. Whether I use the money or I leave it to my wife or my kids, hopefully they'll be able to take advantage of tax-free use of those assets. And again, they're growing, right? That's the beauty. They're growing in the IRA. So long as I don't take them out, they're going to keep growing without tax. And when I do pull the money out after the age of 59 and a half, it's all going to be tax-free. So it's the best legal tax shelter out there. Other than life insurance, you're not going to get a better play. The advantage of life insurance, obviously, you can get it out of your estate. There are advantages of life insurance. They're very compatible, Roth IRAs and life insurance. There's a lot of cool stuff you can do with life insurance, and a lot of cool stuff you can do in a Roth IRA. The difference in a Roth IRA is you can use the money before you die, whereas the life insurance is really, other than borrowing against it, it's really a legacy for your family. The Roth IRA could enhance your retirement and your quality of life while you're living, and at the same time be a legacy to your family. So hope you guys enjoyed today's video. Lots of fun. Really appreciate your support. Don't forget to subscribe because I go live at different times. Who knows what happens? There could be a important case or a new development with the IRS on certain self-directed legislation. So if you want to keep up to date, subscribe. It's free. Why not? Do it. You'll learn a lot. We generally I drop 3 podcasts and 3 to 4 videos a week plus a live. So I think you'll have a lot of fun on the channel, learn a lot, and we'll learn from each other. So appreciate your support. Thanks for watching, and have an amazing day. Take care.